We're half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Yvonne Man with David Ingles.
Good morning. Let's get to your top stories today. Japanese stocks capitulating for a second day as expectations grow of further rate hikes from the BOJ. The yen rally rolls on this Friday. Now, global treasuries are now on their longest winning streak in 8 years on the prospect of easy monetary policy. You have weak U.S. data adding to the case that the Fed is dragging its feet on easing policy. And the tech sell-off continuing the Asia-Pacific following disappointing forecasts from Amazon and also Intel. While you look at Apple, China remains a weak spot for the company.
Yeah, you're seeing a bit of a classic risk-off day here as we wrap up this trading week, and certainly you're watching what's going on in the Treasury market. We're focusing on some of these growth fears that have been emerging here in the U.S. So we had that jobless claims that was higher than expected. ISM data also continue to show deterioration there. So you continue to see this bond rally, extending for another day. And we're talking about a yield curve now in the U.S. where most of which that curve is below that 4% threshold. We saw that with the U.S. 10-year yield. We're at 3.95 levels. We're testing the year-to-date lows for the 2-year now. We're at 412 levels as well. So certainly that's when the watch Treasuries basically had the best month we've seen all year round. And of course, the jobs report, right? Do we actually need a good jobs report, Dave, to actually change the narrative a little bit now? Because it seems like now there is a fear that maybe the Fed is behind the curve. You take a look at when it comes to the rest of the region and what we're seeing here. And Japan, as Dave mentioned, that capitulation, it's one of the biggest 2-day losses we've seen so far if we continue at this pace in basically about 4 years, since March of 2020. So we continue to see that yen strength really playing a part in how that's dragging that index there. But we're seeing a little bit of consolidation in dollar yen at least, but we're still trading around those 149 levels. Sterling still is a little bit heavy after that BOE cut, the first time, of course, we've seen in this cycle. And certainly, Governor Bailey didn't give too much clues on the timing of the next one, but enough for at least the sterling bears to really kind of go run with this as well. But a lot of dollar strength is part of it as well, given that flight to safety. We have to talk about tech. Look at NASDAQ 100 futures. We're still in the red here this morning after some disappointments. Although Apple was actually largely a beat, but the China, the growth headwinds there certainly did overshadow some of the results there as well. But yes, we're watching, of course, that bid across sovereigns here this morning. Oil is also slightly elevated. We do keep in mind OPEC Plus did talk about keeping their output levels there for the next quarter as initially planned as well. But we're watching still the growth fears play out in the likes of copper, iron ore. Look at the Dalian futures. We're down close to 2%, and gold catching a slight bid. The approach to the open in China is looking like this here right now. We're still watching this relentless rally in CGBs as well. We got another warning, it seems, from authorities here about, really be careful what you do here. 211, there you go, for your Chinese 10-year yield. That is yet another fresh record, I believe. And we're watching futures there in the red this morning, Dave. Yeah,
a lot of the comparisons we're making right now when it comes to these markets goes back to March of 2020, and that's really when the pandemic hit, right? So the sort of moves we're seeing in the bond market and the winning streak there and the drop in Japan, for example, are all comparable now to the sort of wild days back in 2020. The data does suggest, and when you look at the jobs recap so far from this week, and we're also including, by the way, the employment index in the ISM numbers, which came in softer to 43.4. So apart from jolts, for example, all leading, all contributing to this narrative that it is softer data as we go into, of course, the jobs report later today. So all things equal, markets are not pricing a cut at every remaining meeting at the Federal Reserve.
Yeah, and even you're seeing a little bit more pricing in September that perhaps it could be more than a 25 basis point cut.
Yeah.
So there is this little tilt towards maybe we need those emergency cuts, just given how quickly the data has turned. We'll see if that's the case, right? But take a look at what we saw. The JOLTS ISM, we talked about that. We'll see if the jobs report today will change anything. Let's get in our live strategist, Mark Cranfield, joining us from Singapore. Let's start with Japan first. I got to talk about that. Just given these outsized moves that we're seeing post BOJ, how long can this sell-off kind of last, you think?
I think there's a lot of people would love to know exactly where this is going to end. We were just looking this morning at, for example, the Topics Index, which is testing its 200-day moving average for the first time in well over a year. Now, long-term Japanese equity investors just a few weeks ago were looking at that 200-day average in a way hoping that they would see it as a good opportunity to get back into the market. But now they're probably too scared to do that because they're facing, for the first time in 2 decades, Japanese investors are realizing that the Bank of Japan is hawkish. They haven't had to deal with this for a very, very long time. And it's a new dynamic which comes at the same time as you were discussing. The Fed may be behind the curve as well. So Japanese investors are getting hit from both sides. There's nothing to help them from monetary policy in their own country, and the tech sell-off overseas is also hurting them as well. So at the moment, what looked like maybe a good dip buying opportunity now is just looking like a falling knife, and people are just stepping away. So all of these things which have been positive for Japan, the improvements in corporate governance, the improved dividends, the fact that the yen have been relatively weak, helping exporters, for the moment, none of that matters. People just want to cash in where they can and move to the sidelines for a while and see how the dust settles. It's probably being overdone right now, but it's very unlikely to improve to today's. Being a Friday going into a weekend, is very unlikely to get much better today. Maybe next week there'll be something which restores the balance, but today's going to be ugly.
Yeah, well, let me brighten the mood, Mark. And we look at the bond markets, you know, we're catching quite a bit there as far as global treasuries go. I mean, the 2-year, we woke up this morning, 2-year yield was down 10%. We're down further today. In fact, we've taken out the low at the start of the year. We're now back to, I think, 2023 levels in the 2-year yield. Bonds did exceptionally well as well. Gilt, because of the Bank of England. How much further do you think markets should be leaning into this bond rally 8 days in?
Well, it's a similar story there. You might think it's getting a bit overdone. The fact that the 10-year yield has dipped below 4%, for some people that will probably be enough. They will probably be saying, if you'd have told them 2 months ago that the 10-year yield was going to dip back below 4%, they would probably say, wow, that's way too much. But now, when you see some of the data coming through, clearly the jobs market is softening. Those JOLTS numbers don't always translate into weaker employment data, as we're going to see later today. But Jerome Powell did cite the jobs market in this week's Federal Reserve meeting. Clearly, the Fed is starting to get worried about that market deteriorating, on top of the fact that inflation is coming down. So it wasn't too long ago we were all talking quite comfortably about a soft landing. The way the Treasury market is going, people will pretty soon be talking about a hard landing. So if we get follow-up data, starting with the jobs report today, we've got 2 more inflation reports before the September Fed meeting. All we need is a few more negative numbers, and people will say the Fed needs to move 50 basis points in September, not 25 basis points.
Mark, what if we get a strong jobs report later today? Might that engender some selling in the Treasury market?
Actually, yes, that could be a circuit breaker, particularly in the bond market. The bond market seems to have got very heated up about the risk of the Fed doing several cuts this year. So certainly that would be, for them, it would be a turnaround for the bond market. Whether or not the equity market takes it well is a big story, because the tech sell-off is pretty severe, and they might not even see a good jobs report as being very favorable anyway. So the equity market might need a lot more, particularly as some of the things here in the tech sector have suggested that maybe this AI story is not quite as hot as it was. And we haven't had NVIDIA yet. It's still a few weeks until NVIDIA reports. So turning around the equity market will probably be more difficult, but certainly treasuries could take it on the chin.
Mark Cranfield there, warming us up to what's shaping up to be a down Friday here. Our MLive strategist in Singapore for us. In fact, speaking of tech, we'll have more on the tech earnings coming through in a couple of minutes here. Of course, counting down to the open of trade. Also, Shanghai, Shenzhen, and here in Hong Kong. This is the China Show. Right, welcome back. You're watching the China Show. Let's talk earnings here. So Apple out with quarterly results, of course. Sales up, in fact, more than expected here. But when you look at the revenue it gets from its Chinese market, remaining weaker there, shrinking 6.5% on the China business. We heard more, in fact, on China from the CEO, Tim Cook, during the earnings call. Have a listen.
During the quarter, I should say also that iPad returned to growth in Greater China as it did around the world. And so we continue to be confident in the long-term opportunity in China. I don't know how every chapter of the book reads, but we're very confident in the long term.
Yep, that was Tim. Let's bring in Tom Giles, our senior executive editor in San Francisco for us. Yeah, Tom, China business and the broader business, get us up to speed on what the company said.
Yeah, that was not an unequivocal endorsement of the long haul. Everything's going to be just hunky-dory in China from Tim Cook. We don't know how every chapter is going to play out, but this last quarter, things were not great in China. As we've talked about many times on this show, the picture for China is not always that bright right now. You've got economic growth questions. You've got competition from local smartphone makers. And third of all, you've got discouragement by the Chinese government on use of the iPhone in certain circles. Those things taken together suggest not a rosy picture for the iPhone in China, which of course is its biggest product. Now, Apple was quick to say that really this was more about foreign exchange headwinds than performance there. And they really encouraged people to look toward the future for the company as a whole. Some bright spots. As you heard, Tim Cook talked about the iPad. That did much better than expected across the board, including in China. The other thing that Tim Cook and Apple executives want you to focus on is AI, artificial intelligence. How is that going to change your experience of using products, using the iPhone, using the MacBook Pro, et cetera? And he's saying that we're excited about the future, and that is going to give people another reason to buy and use and stay loyal to Apple products.
And I guess it does beg the question, do these earnings actually matter then, Tom? Because since everyone is actually just looking ahead to the fall anyways.
Well, this quarter is historically not one of the best quarters. Right now, people are waiting for the next iPhone that comes out in the fall quarter, and you don't even see a lot of that until the quarter after that, the quarter ending in December. So this is not historically one of their strongest periods. You're right, people are looking forward. They want to see once you start inserting artificial intelligence into the phone, how does it change my experience? How does it change the way I use Siri? How does it change the way I basically carry out search and other features on the phone? Apple is investing a lot of time and energy and resources into answering that question. I think people are really on the edge of their seat to figure out what is that going to look like. So if you're on the fence about whether to buy an iPhone now or in the future, you might hold out. But again, overall, this was not a bad quarter for them. Sales surpassed expectations. Like we said, the iPad did well. There were a lot of bright spots if you're an Apple bull, and that's reflected in the stock price after hours. Yes, there was a dip down, but as of later in the afternoon, it was up about 1%. So this was not an unequivocal bad quarter for them, and people were not overly focused on the China question.
Tom, thank you. Tom Giles there, our senior executive editor of technology, joining us out of San Francisco. Let's bring our next guest now, Melissa Otto, head of TMT research at S&P Global Visible Alpha. She joins us from New York. Melissa, always great to have you on Apple earnings day. Overall, as Tom highlighted there, this is overall a pretty good report from Apple, but perhaps maybe overshadowed a bit by the China headwinds. What was your overall take?
Thank you. Indeed. Overall, this was a solid quarter and outlook. Both were in line with S&P Global Visible Alpha consensus. No big broad-based surprises. I think when we kind of dig into the numbers a little bit, indeed, China was a little bit lower than expectations, but not overwhelmingly so. And I think net, I would say there was a sentiment around China coming into the quarter that it might come in a bit soft, but The overall iPhone revenues were better than expected, and services very resilient. So all in all, a good quarter, and then their outlook also in line with where consensus is. So there was nothing to really be upset about.
Yeah, but Melissa, talk to us more about services, and if you heard anything on Apple Intelligence, because what's the outlook beyond the current quarter there? Because that's the margin game for the company, isn't it?
Indeed, services generate nearly double the margin of products. So I think the more that they can accelerate the growth of the services business, the more it's going to likely drop to the bottom line, and the happier investors are likely to be. And they talked about the general resilience of it, that they're continuing to see positive momentum coming into services. One of the areas that I think is really interesting in the earnings call, management pointed to the fact that the iPhone 15 is actually outperforming the 14. And they talked a little bit about, they didn't come directly out and come right out and say it, but they kind of talked around the idea that Apple Intelligence may be one of the reasons for this, and saying that, this could be laying some of the early groundwork, early innings, early indications that Apple Intelligence may start to enable, incentivize consumers, users to move toward that next generation phone. And that ultimately, I think, is what may support the services business, because you've got cloud in there, you've got content, all these things that are in the services component of the business are things that are probably going to be supported and enabled by this next generation phone. So I think there's this working in tandem together that I think can really potentially support some long-term growth for the company.
Yeah, you mentioned, overall, maybe the China wobbles aren't as of a concern. How do you think the company can reemerge out of the slowdown in China right now? Is it less concerning given the fact that Apple is doing well in other markets?
That seems to be the issue, is that the slowdown in China isn't so meaningful that the growth in other markets isn't offsetting it. And I think that's what we saw this quarter. If the drop off in China was meaningfully more than the uptick we're seeing in other international markets, then I think there might have been some real concern. But we didn't see that in the quarter, and looking out to next quarter, the guidance did not indicate that.
Melissa, just to pivot now to Amazon, and the concern seems to be, and obviously a good set of results, I should caveat that too overall, seems to be in margin guidance. Are you concerned about margins?
Yeah, I would say Amazon was a tricky one this quarter. In the quarter, revenues and operating profit were great, driven by AWS. The AWS margin was fantastic. And even when we adjust for that 200 basis point bump that they got from the change in accounting around servers, it still outperformed by over 100 basis points. The issue, I think, really came around two things. One is the North America retail margin was expected to come in at 5.9%. That came in light at 5.7%, number one. And number two, the guidance going forward was was essentially already priced in. The guidance is over $15 billion, and the guidance was a range of $11.5 to $15 billion, but the consensus is already over $15 billion in operating profit for next quarter. So it suggests that the current outlook is already priced into consensus. So I think the market didn't like that. And we're seeing that across the board. Many companies that are reporting guidance that is essentially in line with expectations or slightly soft or slightly south of expectations are getting hit with underperformance.
Melissa, thanks for staying up for us, and let's talk again soon. Melissa Otto, their head of TMT research at S&P Global Visible Alpha on Apple and also Amazon. Right, going into the open today, we're looking at declines in the Hang Seng in the early goings. We're down about 1.6%. If you do think you're getting depressed looking at this, just look at what's happening in Japan, and that will cheer you up immediately if you're a China bull today. Plenty more ahead. This is Bloomberg. Right, going into the open today, I mean, we look at most things China, but, the broader macro conversation is driving. So we had the CGB rally taking place, and what's going on as well in recent days is it's been joined now by other government bonds. So you put everything together, we're now 8 days of gains. And this has really been one of the few bright spots across cross-asset, cross markets. And as you can see, your 10-year yield is below 4%. The 2-year yield just took out the low of 2024. We're now back to May 2023 levels. So this is ahead, of course, of the jobs report coming out later today. As it pertains to the bond markets in China, high-yield bonds have been doing very, very well there. I think we're up a 9th week. There's a CGB sale today, 30-year bonds. A briefing on the outlook for external demand, perhaps, and of course other sectors related to the earnings coming through.
Yep, and we talk about the sell-off in stocks. It's not just in Japan, but we're starting to see it in the pre-market in Hong Kong. So we're once again testing that 17,000 level for the Hang Seng. HS Tech is on offer here today as well, and the currency is still looking a little bit weaker now, about 725 from just a day ago there, and 6,000 is a level for H shares to watch here today as well. In terms of stocks to watch, there was some EV sales data that came out for the month of July. It was a pretty mixed picture, but it looked like BYD and the likes of Li Auto still was able to generate some decent numbers here compared to a year ago. But I don't think it really kind of matters today, just given what Dave's mentioned, right? The sell-off that we're seeing, the macro sort of headwinds that we're seeing across these markets here as well. So there you go, NIO. That was one that actually did see a slowdown, though, in some of these deliveries. We're down close to 7% here this morning. So it doesn't look too pretty when it comes to how this open is going to look like in China as we wrap up this trading week as well. Obviously, CGBs is still the key question here. But yeah, right now, not a lot of bright spots really in these markets. You're watching the China Show. The open is next. Welcome back. You're watching the China Show. It's not looking to be too much of a happy Friday if you are really leaning into risk just yesterday after the Fed. A lot of it has actually reversed in just the last 24 hours ago, just given some of the growth concerns around the U.S. That Japan sell-off continues to be quite relentless here right now. And you're starting to see the spillover effects coming through here in Greater China. So you take a look at Hang Seng, we're down 1.5% or more right now, 725 when it comes to the currency. So we're back on some of the weaker footing when it comes to the renminbi here. Given that dollar strength, there's been a flock of kind of these haven flows back into the dollar, back into the yen, back into the Swiss franc of late, and obviously that flows into treasuries as well. A50 futures are looking like this here, so it looks like we're set for another week open here today for the CSI 300. It looks like we are starting things off that way as well. There you go, onshore Shanghai looking like this. We're down 0.75%, Dave. Yeah, we were past 10s, supposed to be looking at the best week for the Shanghai Composite since May, so we'll see how things shake out throughout the session here. But as you can see, declines just about across the. This weekend cannot come soon enough. Frankly, flip the boards, please, and have a look at Hong Kong. By the way, there's a 30-year bond sale today. Keep your eye on that. That's in about an hour from now. We also have a briefing on Chinese trade, so keep an eye, too, on that. Okay, the shakeout in tech is really pulling down the markets in Hong Kong. As you can see, all of the big ones are down today, from Tencent all the way down to Construction Bank. We're down 2%. We've now taken out 17,000 on the Hang Seng Index, 1.5%. It's not been a good. It's not been a good week. Well, it's not been a good 3 weeks for stocks. I think we're poised for a third week of declines on global equity markets. Yvonne talked about some of these
industry data on car sales and EVs. As a part of that, obviously, have a look at where we are here on the likes of NIO and Geely. So NIO got absolutely thrown out the window overnight, and XPeng. So we're looking at moves on the back of that, and also some of the sales data that's come through as well. More on this in a moment. Apple suppliers, Apple out with earnings. The 15 did better than the 14, I believe. And, of course, we're looking ahead to the Apple iPhone 16. Declines in AAC Tech. Lens Tech is the one listed onshore. And also some money being taken off the table on these gold mining stocks, which have done exceptionally well. And we're trading, I think, about $40 or $50 short of the record high as far as gold is concerned. To Yvonne's point, it's really about haven so far.
Yeah, it really, you can't really focus on individual stocks today, I feel. That really is more of this sort of macro sea change that we're seeing across these markets here right now. And that's why you're seeing gold continue to edge around that 2,500 level. Maybe we'll get to that next one. But yeah, you're watching the spot actually for gold. Spot prices are actually close to another record again. For more, let's bring in our Asia equities reporter, Charlotte Yang. She's with us. Okay, EV stocks in the spotlight as well, but it doesn't seem like investors really care about these results that we see so far.
Yeah, it's definitely like a risk off and sell off of everything. But still, I think there are some interesting takeaways from the July sales data they've just released. I think the biggest surprise is with Otto. So the stock last year was one of the favorite, but this year has been largely standing on the sidelines because of the new model that wasn't so well received. But for the month of July, they actually posted 51,000 vehicle sales, and that's a historical high level. And the management said it's actually helped by this autonomous driving software they just recently pushed out for one of its models. And for BYD, it's another record month, but there are some concerns with the losing momentum, the moderating momentum if we compare on month-over-month basis. And that raises concerns about, the rising inventories and if they're going to, introduce more price cuts to boost the model sales.
What else are you guys looking at for the rest of the day, as far as earnings, eco, and anything else?
Yeah, so I think for today, it's definitely going to be what regionally we'll be doing, but I think a lot of the attention is shifting to next week, where we'll be busy actions with eco data as well as earnings. And if you think about, how the Chinese assets earlier this year, stocks has been benefited whenever global investors took off money off the tech, off the more expensive ones. I think the data next week, such as, the private factory data on Monday, and then we have CPI, PPI coming, and also about the trade data. If we can see some positive, surprise from there, or the earnings which Alibaba is estimated to release Friday, and we have SMIC as well. So next week is going to be a busy week to watch.
Yeah, well, a good thing I'm off.
You're not off the whole week.
Yeah.
You're off for a few days. But yes.
For the most part.
He's heading off to a nice beach. Yeah. Very jealous. All right, Charlotte, thank you. Charlotte Yang, our Asia equities reporter, joining us here and what to watch for next week as well. We're hearing some comments, very interesting ones actually, from a PBOC advisor issuing a rare critique of Beijing's economic policies for being overly conservative and urging the government to ramp up fiscal stimulus and promote inflation. For more, let's get to our China correspondent, Min Lo, joining us. We're talking about some of these comments from Huang Yiping. What did he have to say?
Yeah, Huang Yiping is a very important figure in Chinese economy. Dave, he is the former chief economist at Barclays and Citi as well. He's now a dean at Peking University. And he is now calling for the government to set a firm inflation target of between 2 and 3%. Now, China already has an inflation target of 3%, but obviously the government has been prioritizing growth over inflation. So the current inflation is just hovering above zero. And this guy is saying, look, we need to elevate the inflation target to the same level as the growth target. And he says that the big problem in the Chinese economy now is that the macroeconomic policy is too cautious, and there is a reluctance and inability among local governments to enforce these stimulus measures because of fiscal constraints, because of that property downturn that led to these deflationary pressures and even recessionary pressures among households, enterprises, banks, and local governments. So he's calling for cash handouts to households and migrants that are moving to the cities to encourage them to consume more. So it's quite rare actually to hear such a strong critique of the economy, because the space for public debate has been narrowing in recent years. And just recently as well, the former chief editor of Global Times, he was banned, that's Hu Xijin, banned from posting on social media after he posted something about giving equal footing to private enterprises. So it's just becoming more and more sensitive these days.
Yeah, I think it was a post on Saturday, if I'm not mistaken, just this weekend too. More broadly, though, on some of the longer-term reforms, we're getting more and more a drip feed of these conversations. So this 5-year plan on urbanization, what do we know? Because this is a fairly big deal as well.
Yeah, it is quite a big deal. So the government is now asking local governments to provide more social services for migrants living in cities, for the permanent residents there, rather than only those who have the household registrations or hukou tied to the city. So there are about 177 million migrant workers, about a third of the urban working population. Most of these migrant workers have their hukou or household registration tied to their home provinces back in the rural areas or other places. That means they cannot access social services in the cities. Their kids may not be able to get a space in a public school in the cities. So what this plan does is three things. Number one, it could make the migrants feel that they can cut down on their precautionary savings, so more consumption, good for the economy. The second thing is if they can, access social services there, the kids can go to school there, maybe they want to bring their kids over, maybe they want to upgrade their housing. So the plan calls for government to provide more subsidized housing, more public rental homes, so that helps to clear up some of that excess housing inventory, so good for the property market. And the third thing is, as more people come to the cities and they make use of the transport services, the healthcare services, then the government need to invest in upgrading the hard and soft infrastructure. So more government investment, again, good for the economy. So it's a big stimulus plan in disguise. And this has been talked about for a long time now, but it hasn't really taken off because of the fiscal constraints of the local governments. They cannot afford to absorb all these migrants. They're going to take advantage of the free social services. So the government is now going to link the central fiscal transfers to the urbanization rate. They're going to give them more land allocation if they absorb more migrants as well.
Yeah, I think you make a very good point. This addresses two of some of the biggest issues right now, which is the housing issue and also the consumption.
Yeah.
Min Lo, thank you so much, our China correspondent there. We'll take you straight back now to Japan and an update of just the carnage taking place in that market today. So just about everything is down on the top, 97% of stocks. And this is a gauge of 2,100 and change stocks. So just about everything is down. Yeah, volumes are about 70% heavier than usual. So, and this is the second day. It did this almost yesterday too.
I mean, there was already close to a similar measure in terms of how much it would decline, right? We're talking about 8-9% declines now in just 2 days.
Yeah.
After this BOJ meeting, it's interesting that how the narrative has changed, right? You start to see a lot more economists saying, pushing forward a lot of these rate hikes now from the BOJ, that maybe the BOJ policy reaction function has really kind of shifted in a bigger way than maybe market participants had really foresaw before. And even the likes of Kazuo Moma, he's a guest there from Mizuho that talked in this Bloomberg interview yesterday, was saying, look, there's a very high chance they could hike again in October.
Right.
And you're even talking about January and April now as maybe possible other dates that we could see another hike.
Yeah, that's a good point, because we were, up until the meeting this week, we were almost in a meeting by meeting conversation. And then they opened up the possibility of more high. Hey, we weren't even talking about the October meeting, but since you brought it up, here you go with markets. And as you can see, so yesterday we had a massive move in banks. We are seeing that today. So Daiwa Securities is down 18%, and some of the big banks. And there's also, by the way, some decent earnings that have come through today, this week from financials. But as you can see, markets are taking money. I should also mention that banks and insurers have done very, very well this year.
Yeah.
So there's also obviously an element of profit taking place.
All right. Coming up, we're talking a bit more about Macau. Gaming revenues falling short of expectations in July. We'll get the outlook next from Bloomberg Intelligence.
Right, welcome back. So we're looking at Macau closely now. So yesterday, and as you can see, this is 11.6% is the latest print on casino revenue. It's year on year. That's for the month of July. As you can see, we've come down substantially. There were base effects in play, obviously, in 2022, 2023. That's gone away. This one actually coming in slightly below forecast of 14%. Going into today. All right, so let's get the lowdown right now on why we're seeing all of this and what the outlook probably means for now. Our BI senior analyst, research analyst, Angela Hanley, is here to talk us through, of course, the reason behind this sluggish growth.
I think the weakness some people might be saying is because the free snacks are over, and also because people are not going to Macau. But I think the difference is that we are seeing the traffic is very, very strong, but the per head spending might be a bit lagging behind. So for the traffic side, what I see is that at least hotel rooms are very expensive. I don't think you want to go to Macau paying that price. So it's like the price is double of the level at the beginning of this year, and maybe even like a 40% higher than in summer last year. So it's very expensive for hotels that we monitor, which is basically about those hotels with casino floors and more than 300 rooms. So in this case, I feel like it's not really about traffic, and we're also seeing pretty strong demand for Hong Kong and Macau. For those Chinese outbound travelers, they might be saying going to Japan is already becoming more expensive, but they still want to go to Hong Kong and Macau. So I think it's not really about the traffic, but it's more about the per head spending, given that we have been seeing some suspension of some type of really attractive rebate programs for gamblers. So maybe that kind of promotion was the issue.
What about this crackdown in Macau from China as well?
Yeah.
We heard that from state media starting in June about loan sharks. They made some arrests and all that.
Correct. So it's not just about Macau. We have been checking with people in other cities like Singapore and other places. They're all seeing that casinos are seeing less Chinese big gamblers coming back. I think China is controlling a lot on the money flow, fund flow out from mainland China. That's the reason why we are seeing some weakness in the high-end spending or high-end gambler side.
So we're about halfway through the year. Are you lowering your forecasts for 2024?
So far, I think I'm fine with that. We are still keeping the forecast of 75% of pre-pandemic levels this year, implying more than 20% growth this year. And I think the market should be similar. The reason is that the number has been very strong at the beginning of the year, but nobody was actually upgrading much numbers. So I think we are kind of comfortable with numbers now. But I think a more challenging side should be next year, because we are seeing that given the traffic has been already very strong and also all hotel rooms are very occupied, then more about per head spending. So I think maybe we are heading for mid-single digit growth next year. So we are going to see a big slowdown. So it's going to become a market share game. So this year in the second half, we are seeing some positive coming for Galaxy by gaining share. Next year may make sense after all these renovations. You won't be able to stay in cheap Sheraton anymore. It's going to become like a Lunar Grand. So it's maybe less rooms, but bigger rooms, and then maybe more expensive. So these are the changes that Sands is doing.
Okay, bring your family, bring your friends. Don't need to, fill one room.
Yeah, no need to get separate rooms.
Just get the suite. Yeah. All right, Angela.
It is expensive, though.
It is. People are, and they're going just, even families are going much more than just the gamblers. Angela, thank you. Angela Hanley there, our Bloomberg Intelligence Senior Research Analyst for Asia Pacific Gaming and Hospitality. Now to some other big corporate stories that we're following for you today. OCBC has reported a second quarter earnings beat as a strong haul in trading and wealth fees helped bolster tepid lending income. Southeast Asia's second largest lender says net income increased 14% to $1.4 billion US. The CEO, Helen Wong, says the lender is, quote, firmly on track to meet this year's targets. Norin Shuken Bank posted a $2.75 billion loss in the first quarter after making bad bets on interest rates. The Japanese agricultural lender is unwinding about $67 billion of U.S. and European government bonds this fiscal year. Norin Shuken also says it's planning to raise more capital from member cooperatives to rebalance its investment portfolio. Adani Enterprises reported strong first quarter profit boosted by solid revenues at its airports and mining businesses. The flagship unit of the Adani Group says net income reached over $170 million, marking a 115% jump from a year before. Adani's empire has been regaining lost ground after battling a scathing short seller attack last year. And next week, we're going to have a special in-depth coverage of the Adani Group beginning on Monday. We're going to speak exclusively with Asia's second richest person, Gautam Adani, as he oversees a real-life succession story. We're going to meet the family members handpicked to take over the conglomerate controlling large parts of the infrastructure behind India's $4 trillion economy. Our coverage culminates with a special report next Friday. You don't want to miss the series. Plenty more ahead. This is Bloomberg.
Right, welcome back. Let's talk about the rate decision, of course, that we saw on one of the most important, of course, the Bank of England. We had the Governor Andrew Bailey talk about rates and how he thinks they will settle at above pre-COVID levels following that decision, of course, to cut interest rates. We asked him, too, what officials need to see before they decide to cut rates again.
Well, we were looking for, in a sense, for sort of confirmatory evidence. We weren't looking for something to change necessarily. It was confirmatory evidence. We had that. I think we had, certainly my view is we had that. But we will be looking at this framework and saying, are we seeing this sort of rather more benign comp process which we can sort of further confirm? Or does this sort of structural issue, which is why we've put this sort of risk in, that maybe COVID, for instance, has changed some elements of the structure of the economy, which is going to make the thing more sort of resistant, if you like, to measures to get inflation down. And that's the judgment we will have to keep coming back to.
Where do you think rates settle? Is 4% restrictive?
We don't have a number on it. What I would say is this. I think it's reasonable. Don't expect we're going back to zero, because zero was the product of huge global shocks, starting with the financial crisis, then obviously COVID as well. I think to get to there, something really bad has to happen that we're not currently expecting. So it'll be somewhere obviously in between. I think we've made a big point of saying policy is currently restrictive, so you can deduce from that it will be lower than where we are today, but I think it's very clear that we're not going back to zero.
Governor, the government has said it will borrow an extra £16 billion this year. Does that change the calculus around rates?
Well, I'm going to wait for the budgets on the 30th of October to see the full picture, because we always condition on an announced fiscal policy. That's what we will see at the end of October, and we'll sort of put it through the machinery at that point.
So the Fed, the ECB, the BOJ are all adjusting policy, and that's very clear, and that's trying to make some big change in foreign exchange markets. What are those, what of those elements are actually important to you and BOE policy?
Well, we obviously don't have any target for the exchange rate. That's all a long way in the past in terms of that sort of thinking. But obviously the exchange rate feeds through in terms of financial conditions. We've seen some appreciation of sterling since we did the last report and forecast in May. Sterling has appreciated. We fed that through, as it were, so it changes import prices and so on. And that's how we tend to look at it, actually. I would say recently, over the last four or 5 years, actually, in the sort of transmission of mechanism of monetary policy, exchange rates have not played a very large role. And I think the reason for that is because we've all been facing essentially global shocks. So these are not sort of specific shocks that affect one central bank but not another. We're all in the same place, really.
And that was the Bank of England Governor Andrew Bailey speaking with Bloomberg's Francine Lacqua. And I check these markets here. It is not a good day. You take a look when it comes to what we're seeing.
Not at all.
Japan continues to see some sizable declines here right now. We're watching some of these big tech stocks and some of these Intel sort of suppliers, just given what they saw, the sales slump, showing that maybe the price of falling behind when it comes to this AI race. And that's really, it's not just an Intel story, basically. You're basically seeing this rotation trade. I mean, is it really over, too, is one thing you're wondering. But the tech, U.S. tech earnings have just really not played out as well as analysts had hoped for. And that really is roiling this tech trade as well. And that's really dragging the likes of Japan. Korea is also down close to 3% losses. Mind you, SK Hynix is really one of the biggest draggers there. We're down some 8% for that stock as well. It's looking a little bit better for China compared, relatively speaking, right? It's basically been a broad sell-off across equities here today, Dave.
Yeah, we're looking at the CSI 300 flat, which is, on a day like today, is really an outperformer. The CGB space, so in the next 2 hours or so, we should be getting some details on this 30-year CGB auction that's taking place. We'll also be speaking, of course, with, having conversations around how to trade at this point in time, the CGB rally. And just very, very quickly, when you look at the Chinese market, as Yvonne was alluding to earlier on, this is just a sorry state of markets just about across the region. We are extending that sell-off globally right now. It's one of those days where it's almost a keep your hand in your pocket, by your wallet in case you get nicked. When you look at global equity markets, on track for a third week of declines. Global macro movers, please, if we can, get it up on your screens. We're also seeing declines across the commodity space. So copper is down 2% in Shanghai. Iron ore is down 1.2%. But as you can see, the real bleed is taking place in global equity markets. As a function of this, we're looking at chip stocks too as a group. So we showed you TSMC, SK Hynix, so we're down 4.5% on the Bloomberg Asia Pacific Semiconductor Index. So we'll get you guys an update, of course, on this bleed that's taking place, and of course also where we go with interest rates, right? So markets now fully priced, one cut at every meeting from the Fed. Possibly do we get 50 at the next meeting in September? More conversations just ahead. This is Bloomberg.
Welcome back to the China Show. Here's a look at the HSI half hour into the session here, and really Hong Kong joining in on this global equity sell-off here, and we're continuing to see declines about 1.5%. The downside for when it comes to the Hang Seng. We continue to see what's really roiling is Japan, where we've seen the biggest sell-off in basically 4 years, 2 days after this BOJ meeting, and really the Kospi is being dragged down with it as well. So those two markets really being the biggest drags here in the region. When we talked about just volumes are picking up, over 95% of those topic stocks are dropping today.
Yeah, everything out the window, every single sector is down.
Financials, yeah.
Financials are getting dumped substantially, 8-9%. Dai was down 18-19%. When you look at a market like Korea, that Yvonne is pointing out as well, you don't see in your screens, but the Kospi is off 2-3%. SK Hynix, which is a big chip play, as a representation, I guess, of that specific part of the equity market, is off 4.5%, right? So, well, SK Hynix is off 8%. So all things equal, we're down 2.5% on the regional benchmark. Nasdaq futures are also getting pulled lower, and this is really more an earnings story after the bell, and some of the big drags we're getting there in the after-hours trade. Not so much in Apple, maybe Amazon. Gold is moving up. Dollar yen is reflecting, I guess, the risk aversion that's out there. So you have gold, you have that. Brent is still moving up as well. And as you can see, a lot of the growth-related commodities are getting pulled lower as well. Copper and also iron ore on your screen. And this really takes us into what's suddenly become front and center in terms of the narrative, that the global growth outlook has suddenly softened almost overnight. It's almost like we turned a page, and then that page had the R word in it when you look at this move in treasuries. And global treasuries are up 8 straight days. And the last time we actually saw 8 straight days was when the pandemic was whipping the global economy and lockdowns back in July of 2020. So we haven't seen a streak like this going back 4 years.
Yeah, and you take what the swaps are pricing in, right? There's a 25% chance that we might see a 50 basis point cut in September now. So you talk about this sea change. It's like we've gone from we're in a soft landing to now, no, the Fed's going to have to front load these rate cuts in some ways to help support growth. Has it gone too far? We talk about that yield curve, most of it, parts of it which are below 4%. The 10-year certainly is the one that we're marking very closely here this morning. And it really was triggered by that U.S. data that we got overnight. So these U.S. jobless claims was higher than expected. ISM data as well. Continue to see contraction there of 46.8. You take a look at the subcomponents like employment, new orders, all didn't look very pretty either. So bad news is bad news, basically, across these markets here today. The U.S. jobs report, you got to wonder, if we see a good print, does it at least change what's been the sentiment overall here? We almost going to need a good report to kind of calm down the markets right now.
We might need, in the same way that we always hear this barbell strategy, we might actually need a good jobs report to just engender some of the selling that's taking place. Well, that isn't taking place in the job market, in the bond markets right now. So let's get a sense. Have markets overreacted? Have we overcorrected the other way as far as this drop in global bond yields are concerned? Joining us here on set is Christiaan Tuntono, Senior APAC Economist at Allianz Global Investors. Good morning and happy Friday.
Good morning.
I mean, are bond markets spot on here? Rate cuts are coming. Collect your gold medal at the gate?
I think many things actually happened as how we expected. I think we were anticipating Fed rate cuts. But also looking at the latest market actions, I think what really shows is the most volatile are market sentiment, right? People's psychology on the market. We have to be more cautious and calm in looking at the data, right? Previously, we obviously, sometimes we saw a bad data being seen as good data because that means that the Fed may cut. Right. But once there's a confirmation that the Fed is likely to cut in September, it swing swing more on the downside. And now we see bad data. Actually, market is kind of panicking a little bit about it. We'll see more. I still think that the U.S. should be guiding towards a soft landing rather than a hard landing. But we'll see how the trend goes. And but it's understandable. I think in terms of markets reaction, all this past few weeks is all started from like the weak U.S. CPI data 2 weeks ago, and also the very vigorous yen move. And you really see that this is the pivot time, right, for the market sentiment. So we'll closely watch and see how it's going to pan out. Yeah.
Marcus still think we might see 3 cuts this year. I mean, is that a little bit too ambitious right now?
I'm so used to this roller coaster ride. Right, you remember last year, October, November, we already talking about 3 cuts, and then suddenly during the first quarter, no cuts, and then now we suddenly within weeks we talk about 3 cuts. We'll see. I think what we can be sure is that there will be cut, but whether it will be 3 or 2, I still wouldn't really put it so sure. But I think market expectations is not only that you have 3 cuts and then probably one of them will be 50 basis points. I think that's probably a little bit overreactive.
Are you seeing any risks, whether even a tail risk, that inflation reaccelerates?
There is risk for that because I think one drag over for the inflation is actually on the shelter side. That one's even like 6 months ago, statistically we know that it should actually goes down, moderate as what's reflected in the market rents, okay? But then if we are taking a soft landing scenario, that means the U.S. growth momentum actually are not really collapsing, but actually are still trending around potentials, right, healthily, then there could be resilience, like demand pull pressure to keep inflations afloat, put it this way, right? So I'm not really extremely bearish or dovish on inflation. It will moderate because of statistical base and because of the drag down from housing inflation. You know, rents doesn't have to go down. It just needs to be flat to have the inflation goes to zero, right? So that's how it works. So I'm more like, I would say that inflation could tame further towards the 2% goal that warrant the Fed to cut. But I think right now panicking about outright recessions and much more rate cuts from the Fed is probably a little bit premature.
Is Japan panicking about these rate hikes and what's in store for the BOJ? It seems like, do you think that the reaction function of the central bank has changed this week?
Not really. Actually, I feel that it's warranted a 15 basis point high. I think one thing that you can say for sure is Japan, based on the inflation print over the past years and also the moderate improvement of fundamental economic development, it is out of deflationary trend. It's out of deflation. Okay, you out of deflation doesn't mean you have inflation problem. So the monetary policy should adjust away from an ultra loose policy that they had before and have some minor yield, right, on that. So that's why the rate hike, and also the BOJ is giving a little bit more hawkish than expected signal, is that if growth and inflation continue to trend like what their outlook report was expecting, then there could be more coming in. So, but on the flip side of it, it also means that it's possibly data dependent. And we all see how the global growth and inflation is going to trend out. There's uncertainties listed out in the BOJ policy statements. Don't underestimate those, right? How global external economy going to pan out, how the pass-through effect on Japan inflation going to pan out, how the wage growth going to go in, not only for this year definitely was strong, but next year and next year, right? There's still a lot of puzzles before we can jump in and say, oh, wow, the BOJ is going to race to
well, I mean, arguably to your point, right? They simply reset policy from what's been 10 years of ultra loose policy. We're back to neutral. In fact, real rates are still negative in Japan. Would you describe this as tightening? I mean, let's say they raise 50 basis points.
It is tightening, but I would say that the process of normalizing started very early on, right? Even under Kuroda, when they really widened the band for the YCC and then gradually take away the YCC, right? And these are all the process that they have been taking to step away from the ultra loose monetary policy. And yeah, but I think probably sometimes having a rate hike is the one that really took a lot of market attention. But right? Moving the rates from 0 to 0.1% actually was a rate hike also, right?
Yeah.
Now it's just 15 basis point. But it seems that it's getting tractions, and at least that we probably see that Japan's rate becoming, on a nominal basis, becoming more positive, right? Even on a real basis, it's still negative, but the negativity of it has narrowed because Japan, facing with all these structural problems, still need an accommodative monetary policy condition to help growth, right? But the BOJ is just gradually easing that away. Yeah.
I got to switch to China. Obviously, we saw some of these PMI numbers that continue to look weak here as well. One key thing they point out is the export machine really starting to cool down now?
I would say that it is in line with the global demand also, right? We see the weak ISM number from the U.S. and some of the moderations with demand from the other world. Obviously, that would taper down, right? The protectionist movement in a number of DM economies also put in some stance on that. But it's natural, right? So growth is just about comparing with a period in the past. So I think it's within expectations that export momentum should slow as well. And that's also the reasons why the government has been doing more on the domestic demand side and mentions in the Politburo meeting that they're going to do more, right, on the consumptions to support domestic growth in order to kind of getting the next driver of growth to stabilize growth and reach the 5% growth target this year, right?
Yeah, well, there doesn't seem to be any issue with the growth target. It's inflation that seems to be the other.
Correctly.
Where do you think inflation will be end of next year?
I would just say around this area, this level, very muted, around 0, and probably a little bit higher because the fundamental problem of the so-called deflationary or flat, no price pressure in China is really the lack of domestic demand caused by the corrections in the real estate sector. And so essentially your question is asking me when the real estate sector is going to stabilize, which is a question that I think would not happen this year, probably may happen in next year or probably next year. I don't have a very, very strong inclination of when that would be. But really, when you look across the world, there's no economy that really have very strong domestic demand or consumption when your home price is actually correcting. So we have to wait for it. Since it's a decision of the governments to really tame down on the sector, and we all know that over the past 15 years, China growth has been essentially driven by household sector leveraging up, buying property, and then government use that money to do infrastructure investments. The local government leverage always up. Right, this using leverage in exchange of high growth has ended. Right, it's very clear. So we have to go back and not relying on leverage and rely more on new productive forces and also releasing the fundamental strength of China, like urbanizations, right, and more better fiscal reform to drive growth going forward.
High quality growth, I think, is the ethos right now. Christiaan Tuntono, have a great weekend, sir. Senior economist, APAC, there at Allianz Global Investors. And we'll be hearing, by the way, from BNP Paribas later on here in the show, and why they think we could see fresh stimulus moves from Beijing as we move into the fourth quarter. And, of course, if the 5% growth target then starts to move away ever so slightly.
Yeah, Ju Wang joins us in just a few minutes or so. We're going to leave you with some live pictures out of Beijing. This is the Deputy International Trade Representative Li Yongjie briefing the media on trade measures to promote the country's, as they mentioned, high quality development. We're going to have plenty more ahead. This is Bloomberg. Russia has freed 16 prisoners in the largest swap deal with the U.S. since the Cold War. Among those released by Russia were Wall Street Journal reporter Evan Gershkovich, as well as former U.S. Marine Paul Whelan, who have been detained since 2018. Now, the swap was in exchange for 8 Russians, including an assassin sought by Moscow. Vadim Krosakov was convicted of murder in Germany after gunning down a Chechen leader in Berlin back in 2019.
This deal would not have been made possible without our allies. Germany, Poland, Slovenia, Norway, and Turkey, they all stepped up. The deal that made this possible was a feat of diplomacy and friendship. Multiple countries helped get this done. They joined the difficult, complex negotiations at my request, and I personally thank them all again.
For more, let's bring in Bloomberg senior editor Bill Ferry, joining us live from Singapore here this morning. So what's led to this point? I mean, this sort of hostage diplomacy seems to be kind of kicking in right now. What's driving it, really?
Well, you know, this was the biggest exchange of prisoners of hostages since the Cold War, really, and it was involved some very intricate diplomacy between 7 countries in the end, 24 people, as you mentioned. There are still other prisoners that I think the U.S. and Western nations would like to get out of Russia, but for now, this is the biggest deal that they could secure. It involved a lot of intricate talks between the U.S. and Germany in particular, but we're also talking about nations including Belarus, Poland, Norway, Slovenia at the last minute. Apparently, President Biden called the leader of Slovenia just hours before Biden announced that he wouldn't be running in the election. But what's behind it is this increasing tendency in nations like Russia to take Westerners, in particular Americans, prisoner. We saw that with Brittany Griner, the WNBA star, who was taken and eventually traded for a Russian arms dealer, Viktor Bout. And we know that this particular deal has been under works for months. Originally, the lead negotiators, actually including President Biden and German Chancellor Scholz, thought that Alexei Navalny, the Russian democracy activist who died earlier this year, they thought he would be a key part of this. When he passed away under unexplained circumstances in Russia, it was seen as possibly throwing the deal off, but the negotiators continued working, and we're expecting all these people to land in the next few hours in the United States.
Yeah, Bill, when we say we're expecting everyone to land over the next few hours, is there more work to be done? Who was not included, for example, in this conversation?
Well, we know on the U.S. side, at least, there is another American, Mark Fogel, a 63-year-old history teacher who was taken in Russia, I believe, in 2022, 2023. He is someone who his family and relatives had hoped might be on this list. He is not included, so that will be something that American negotiators work on in the future. And we don't know why he may not have been included in this agreement, but it certainly means that there's going to continue to be more talks going forward.
Bill, thank you. Bill Ferry, our senior editor in Singapore for us. We will leave you now with a look and an update here of the sorry state of these equity markets, and we're down the most in 2 years. On the regional benchmark, U.S. and European futures are also pointing to further losses this Friday. This is Bloomberg.
Welcome back to the China Show. A quick recap of big tech earnings we got out of the U.S. and Apple's reported better than expected revenue growth in the quarter ending in June, but sales in China did fall 6.5%. The company says it sees upcoming AI features to spur a wave of upgrades by its customers. And Amazon sales fell short of estimates, and its profit forecast for the current quarter also missed Wall Street projections. Its cloud business, though, was the bright spot, with revenue jumping some 19%.
Yeah, and Intel shares, let's look at that too. So fell also in late trading after it said sales for the current quarter will be actually below where the markets expect them to be. Now, the company also sees a loss of 3 cents a share. Now, the chip maker says it's cutting more than 15% of its workforce and also suspending dividend payments. Now, on to ARM, and shares are also closing sharply lower in New York. That's after, of course, the chip design company held off on boosting its forecasts for the year. But the CEO told us that he's still quite optimistic about the longer-term outlook.
The way I think about it is as follows. This is our 4th quarter as a public company. It is our 4th quarter of record revenues. As you said, we smashed it last quarter, over $930 million of revenue. So super happy about the quarter. Last quarter, 90 days ago, we raised the annual guidance about 8 to 10%. So when we looked at the outlook for the year, 90 days later, coming off a great quarter, we just didn't feel the need to raise expectations again. So that's really just the backdrop. It's quite simple. We raised the guidance for the year last quarter, record quarter this quarter, and we're maintaining at this point.
Renee, is there anything you can tell me about specific markets that you serve where you see some caution or some hesitation, but you're also able to see whatever it is holding you back working itself out?
Yeah, remember, Ed, that we have two components to our business. We have the licensing business and the royalty business. The licensing business, which is really the forward indicator of demand for ARM technology, never been stronger. The licensing revenue year on year up 70%. What's driving that? That's demand for building new complex chips, more demand for ARM, more compute capability. So that is a harbinger of forward type of demand. Royalties were also up year on year, almost 20%, largely driven by smartphone growth, where units have been modest, but our new version 9 is driving high royalty growth. So in general, we're very, very optimistic about the long-term outlook, particularly because of the licensing activity being so strong.
One of the areas, Renee, you know that I cover a bit more deeply is automotive technology, and I'm just trying to draw parallels with different names out there, understand what's happening. Mobileye told us this morning, for example, that particularly in China, but globally, some of their customers just stopped making orders for the second half of this year. I understand that from ARM's perspective, it's different, right? You think about the pipeline of a specific chip that you're involved in the design of. It's much further afield, longer term. But do you see in that industry in particular any sort of either cyclical process happening or some specific weakness?
Yeah, I think the way we think about the automotive market is we are growing faster in terms of demand for our technology than the market itself. So we were actually up double digits last quarter in automotive royalties. And that's really a function of gaining market share, but more importantly, the quality of the technology that's going in is much higher. These are more complex compute platform devices. They run a lot of software, whether it's for IVI, EV, autonomous. So we're very, very bullish about the long-term automotive outlook. The near-term inventory issues that go back and forth, we haven't been impacted by that so much because, as I said, we're gaining share, and the complexity of our own technology being used just keeps going up.
That was the ARM CEO, Renee Haas, there speaking with Bloomberg's Ed Ludlow. Some more stories that we're tracking for you today. Adani Enterprises reported strong first quarter profit, boosted by solid revenues at its airports and mining businesses. The flagship unit of the Adani Group says net income reached over $170 million. That's marking a 115% jump from a year before. Adani's empire has been regaining lost ground after battling a scathing short seller attack last year. And next week, we're going to have a special in-depth coverage of the Adani Group beginning Monday. We're going to speak exclusively with Asia's second richest person, Gautam Adani, as he oversees a real-life succession story. We're going to meet the family members handpicked to take over the conglomerate, controlling large parts of the infrastructure behind India's $4 trillion economy. Our coverage culminates with a special report next Friday. In the meantime, though, we're catching up with markets here, and it continues to be a global sell-off in equities that continues for another day. Take a look when it comes to the topics. We're down some 5% right now. Biggest drop in about 4 years as well. It really is starting to see more pronounced moves in the Kospi. Australia is also down some 2.5% here. And of course, U.S. futures, Euro futures are feeling it too, Dave.
Yeah, in fact, in the last 20 seconds, we've actually accelerated to the downside of the momentum here. So we're down 1% now is realistic here for U.S. futures in the next few minutes or so. Asia Pacific as a whole is down 3%. As you can see, the biggest drop in about 2 years. Coming up here on set, we'll be joined by BNP Paribas. We'll talk all things rates and currency with Ju Wang.
11:29 a.m. in Tokyo. We're heading to that lunch break, and they're going to need it. Take a look at that. When it comes to Japanese equities, we're down some 5%. That racks up close to about 8 or 9% losses in the last 2 days for that benchmark alone post BOJ. But yes, the prospect of rate hikes there certainly is what's roiling these markets. You have the growth fears that are really reemerging in the U.S. as well. We've gone from basically higher for longer, soft landing to now, are we talking about recession concerns that are showing up in these markets, right? And so you're seeing the Kospi, AXX 200 are seeing some sizable moves there. That's why they're bright red here this morning. TAIEX is also down some 3%. So the tech sell-off continues for another day. Dollar is mixed across Asia FX, but you see that flight to safety into the sovereigns here today, where you take a look at even the Japanese 10-year yield is down some 6 basis points, and Treasury curve, basically most of the parts of the curve are now below that 4%. The 10-year certainly is what we're watching out for. And we continue to watch U.S. futures. Euro futures are all heading lower this morning today, Dave.
Yeah, and it's interesting how, up until last week, the rally in the bond markets, which we're seeing today, was almost exclusively in the CGB space. But you put everything together in the last week or so, we're now up 8 days in a row on the global Treasury benchmark that Bloomberg actually tracks. So it's not just what we're seeing in China, which I'll get to in a moment. But again, you're getting Treasuries, you're getting bunds, you're getting gilt, and that massive move lower into yesterday, which takes us into really wrapping up what's been a terrific 2 weeks if you've been long the CGB space right now. Again, this is the Bloomberg benchmark. You're looking at a weekly percent move. And as you can see, substantial gains in the last 2 weeks or so. The best 2-week rally in 2024. When you look at the swaps marketplace, that's changing things up, please. When you look at, I think we have the 1 and the 5-year do indicate that rates are continuing, well, at least expected to continue falling into the future. Now, that's really driven, at least as far as performance goes, right? So you have a couple of China bond ETFs traded here in Hong Kong and up in mainland China. They've done slightly better than their global peers when you look at some of the ETFs that tracks the U.S. Treasuries in the United States. I think we have that graphic. We're about to show you that in a moment, too. So apart from that, yeah, here we go, of course. I think this is the biggest one as far as AUM is concerned on China government bonds, which, by the way, I almost forgot. We should be getting details in the 30-year bond auction at some point this hour or so. Right. Very quickly, we have a Bloomberg story out on this as well. We have 1, 7, 10, and 30. And the 7-year seems to be the sweet spot, according to Brandywine. That's really where some traders are looking as a place of shelter amid this meltdown we're seeing on the long end, the 7-year, which is obviously thinly traded. But that's where they're seeking refuge. And, of course, I invite our viewers to read about that story, of course. Yvonne.
Yeah, the belly of the curve, they say, you might get the benefits of those rate cuts, but also you're shielded from possibly what the PBOC is trying to do is really counter this decline in yields on the long end of the curve. Let's bring in Ju Wang, head of Greater China FX and rate strategy at BNP Paribas. It seems like we're in uncharted territory now in the CGB market. Are you concerned about the intervention risk? Do you think the PBOC would actually step in?
We think near-term the intervention risk probably has reduced. This is more due to the changing of external factors. As you've mentioned, the market has shifted from higher to longer to worry about the U.S. growth outlook. That definitely take away of concern about a carry-driven RMB weakness. I think the RMB weakness was one of the factors that made the PBOC sound hawkish, wanting a steeper curve in the China CGB market. So as far as global rates are falling, I think as of now, the intervention risk is a bit limited. However, we still have this 530 steepener. It worked quite well since we last spoke during your show. We think the belly is still a sweet spot. The 30-year, the uncertainty would be what will China's fiscal policy do in the second half.
Right. So as far as let's say the 10 is concerned, do we get to 2%, you think?
10, yeah. Yes.
Under 2%?
Yes.
And as far as the steepener is concerned?
The steepener concern, I think, we still believe PBOC has room to cut rates at least one more time in Q4 and 3 times next year because Fed expecting to, initiate an easing cycle. So essentially, if we add up these 4 cuts together, the short-term rates will drop to below 1.5. Then 10-year can drop to 2. Yes.
Wow. Okay. It's interesting, though, because they've been, when they were sounding hawkish, so, we have plenty of money with this crucial tool. I'm ready to kind of sell and borrow these bonds here right now. I mean, if they actually do step in, how effective do you think is really going to be? Is it really just to put a floor across these markets? Or can it actually kind of change the narrative overall?
I think if it's a pure PBOC, it can, at best, put a floor on these yields. However, as I mentioned, the biggest uncertainty is what Chinese authorities are going to do in second half to reach their 5% target. This was specifically mentioned in the third plenum as well as the Politburo meeting. We all know that monetary policy has limits 10 basis point cuts each time, the system is already fully flushed with liquidity. It's more of whether they're willing to do more aggressive policy support on the credit side, on the property side, and the consumption side. If this policy are being rolled out in the second half, then the PBOC's action of supporting long-end yields will be more effective.
Do you think we'll get that? Because markets are moving as if we will be getting larger stimulus.
I think currently it's a window of, Fed is likely to cut. Right. So the yields are dropping first because monetary policy, obviously PBOC cut rates telling you they're already starting to, turning more accommodative. So the fiscal policy will likely to come later. We think even if they don't do so in Q3, because in the Politburo meeting they did emphasize the more effective implementation of current policies rather than talking about additional stimulus. We think even if they don't do so in Q4, there's still a chance of budget CGB issuance like what we had last year. And particularly if U.S. is really having a recession, then external demand for China will slow down, and that will raise the demand for domestic policies to step up to boost the domestic demand.
You mentioned, the renminbi has basically been benefiting from these unwinding of these carry trades, the yen strength that we've seen. How long do you think the yen can actually stay strong? Given that in the back half of this year we have a U.S. election risk, and the fundamentals are very different between China and Japan now.
Absolutely. I think we had 3 rounds of carry unwind over the past 3 years, Q4 2022, Q4 2023, and then Q3 this year, which is happening now. So I think each time at least that the spot will reconverge with the fixing level. And we've already recommended selling dollar CNH versus long dollar CNY NDF trades a couple of weeks ago, and the trades is doing quite well. We think there's still room to go further because each time, the policy maker, the PBOC probably is happy to see the gap being narrowed because that will suggest the FX markets is reaching a new equilibrium of markets function effectively well. So that would be our near-term target.
And for now, where do I look for leading indicators? Is it the yen? Is the yen leading the global FX markets at this point in time?
I think each time yen is a leading indicator for Asian currencies. Obviously, we're observing a massive position unwinding across the board. All the winners now are giving up the gains. All the losers, the Asian currencies are coming back. Particularly the ones with less foreign positioning, for example, Southeast Asia currencies, they're all doing quite well together with the yen.
What is positioning right now, like as far as the data that you're seeing, because that gives us an indication if this move down in dollar yen continues?
Mm-hmm. I think, judging from how big dollar yen has moved up, that the positioning in long dollar Asia is quite high. I think based on BNP's own prop statistic, we're probably at best at a neutral at this level regarding Asian currencies. I think not many people are really selling dollar Asia. Maybe some has put on a bit towards dollar yen, but overall the positioning is not crowded in selling dollar Asia yet.
Okay. Can you get what is the range that you're looking at? Whether it's yen, whether it's renminbi right now for the next few months?
Yen is a wild card. It's everyone's guess. Upside, topside, downside will all be quite dramatic. But for dollar renminbi, I think our initial target would be spot converge with fixing 713, 715-ish level. Okay. If China can step up with more domestic demand supportive policies on the fiscal, the property, the consumption side, there's a chance towards Q4 we can see spot drop back to 710 or even 7-ish level. And that's interesting in a way. That's actually prepared PBOC for better handling the potential tariff risk going to 2025. Because if we assume that U.S. is going to raise tariff to 6%, and if spot move from current 725-ish level up, then the theoretical dollar renminbi will be 770. I think that would be too high for the region to absorb. But if we start with a spot level around 710 or 7, maybe in the worst case, all full-blown tariff war situation, maybe 750. that will be much more easier to be handled by the regional central bank and the PBOC.
Ju Wang, fantastic. Have a great weekend ahead. Head of Greater China FX and Rates Strategy there at BNP Paribas. Right, just ahead here, Singapore builds a flood mitigation tank as it braces for more extreme weather events in the future. A closer look at how the city is future-proofing its openness to events like these. This is Bloomberg.
Welcome back to the China Show. You're looking at live pictures out of Singapore here this morning. And really, we're focusing on the weather impacts, obviously, around the world right now. And the intense flooding around the globe this year has killed thousands of people and caused economic losses estimated in the tens of billions of dollars. That's shining the spotlight on countries' flood defenses. Avril Hong takes a closer look.
Wild weather this year has unleashed devastating floods around the world. From Switzerland to Dubai to Kenya and the provinces of southern China. Hundreds have been killed and hundreds of thousands more injured or evacuated. On top of the human toll, floods cause tens of billions in economic losses each year. The world's largest reinsurer, Munich Re, put last year's global damage at $48 billion. Almost double the amount in 2003. The IPCC, the UN body that assesses the science of climate change, says weather extremes will only get worse in a warming world. That's increasing the urgency for climate adaptation. For land-scarce Singapore, part of the solution is this huge structure beneath the city's historic botanic gardens. The Stanford detention tank is designed to store excess stormwater from heavy downpours. The tank can hold 38,000 cubic meters of water, enough to fill about 15 Olympic-sized swimming pools. Floodwater is channeled here through a canal, all to protect the prime Orchard Road shopping district and prevent scenes like this from reoccurring.
So without the tank and without the diversion canal, Singapore's main shopping district will flood if we experience the same rainfall intensity that we had in 2010 and 2011. But with the construction of the tank as well as the diversion canal, our main shopping district is able to cater for a much heavier rainfall.
Projects like this don't come cheap. This installation cost $170 million to build. Not every country can prioritize spending on climate adaptation, but environmental engineers say not doing so would incur even greater costs.
The consequences are just unimaginable. If you multiply probability with a consequence of what would have happened if you are not protected, that even if it's extremely rare, multiply with a consequence, it could become a significant, disastrous event.
Apart from preventing flood damage, adaptation projects can also pay dividends in other ways by attracting investment.
That actually gives reassurances to investors to, yes, this is the place in which you can continue to operate, run the business. This is a place where you want to build your data centers in. So that justifies the taxpayers' dollars.
So far, Singapore hasn't seen a repeat of the kind of flooding that prompted the building of the tank. For now, the massive facility mostly sits empty, but it's helping to future-proof Singapore, an example for other vulnerable locations in meeting the rising risk from extreme weather. Avril Hong, Bloomberg News, Singapore.
Fantastic reporting there from Avril. Of course, we'll have more heads on the global climate adaptation efforts here. Melissa Chalk of Sustainable Fitch will be sharing her insights with us in the next hour. Up next here on the China Show, we're looking at some of China's highs and lows at the Paris Games. That's next. This is Bloomberg.
Here's your China Brief this morning. A look at what's making headlines in national newspapers and trending on social media. The financial papers are issuing a warning to investors as a rally in sovereign debt continues. And quoting experts, the China Securities Journal says investors should watch out for volatility, with the PBOC expected to move to tame the rally through bond sales. And Shanghai Securities News has a piece on where long-term funds allocated money in the second quarter as markets struggled. It says the funds adopted the barbell investment strategy, buying tech stocks for growth and boosting energy stock holdings as defensive plays. The report says undervalued stocks of select industry leaders also attracted some institutional buying.
Meanwhile, the state-run tabloid Global Times had published a scathing article on anti-doping tests for Chinese athletes at the Olympics. Now, it calls out the U.S. for supposedly politicizing sports, adding that a gold medal win in swimming has vindicated China. Now, the article also says that the U.S. actions have harmed its image, the U.S. image, and casting doubt on America's ability to host the next Summer Olympics fairly. Now, let's stay on the Paris Games here because it's been dominating conversations across Chinese social media, including Weibo, all week. And let's bring in Min Lo here, our China correspondent, to talk us through, of course, where we are on the... So I think China now is ahead on the gold medal count, if I'm not mistaken.
Yes.
Right? And there's big conversations around, of course, the swimming medal.
Yes, so I think one of the athletes, 19-year-old Pan, he won the first gold medal in swimming. He smashed his own 100 meters butterfly record, and that really sent the internet crazy. I mean, if you watch it in China, the CCTV commentator, she just lost her voice, screaming his name over and over. And this is such a big deal, especially because China saw the snub that, the rest of the world gave to China because of that swimming, the anti-doping test we were talking about last week. They were tested 4 or 5 times more than other athletes. And this guy, he came out to give an interview after the event saying that he felt so much expectations from the country. He really wanted to show the world that China can do this. And he said he felt so looked down upon by the other athletes. When he greeted them, they ignored him. They splashed water on his coach. And that's why people are piling on comments to support him. Now, if you show that scroll on Weibo, there are a lot of comments just talking about how touched they are by these athletes, by his performance.
Okay, there you go. Yeah, I mean, he beat the world record by, 0.4 of a second? But it was a wide lead, though, if you watched actually that race.
Yeah, the Australian coach actually came out to say that it was not humanly possible.
And it was also his record, too, right, that he beat himself.
Yeah, his own record. Yeah.
Okay, so this is so touching, such a good young person. When our youth are strong, our country will be strong. All right, yes, definitely a lot of patriotism there. You mentioned about this coming on the back of a pretty weak showing from the swimming team, right? And they are sort of blaming these excessive doping tests.
Yes, because swimming is a sport that China really dominates in, and they have one of their strongest athletes was expected to bring home 4 golds, but he didn't bring back any. He came in 7th in one of the events, and that prompted China's so-called diving queen, one of their ex-Olympian, to come out and blame those anti-doping tests. She said they were tested excessively 7 times a day. They had to wake up at 5 a.m. for the first one. They waited past midnight for the last one. They had no place to rest. They have to wait at the lobby area of the testing area, I believe. And she said that interfered with that pre-competition training schedule. Again, blasting, just this entire unfairness of it all, and also kicked up a storm on social media. We can show some of that quotes as well. Yeah, basically people just talking about how unfair it all is.
Okay, here we go.
Yes, it's a doping test was successfully interfered with our Chinese swimming team. It's not fair. It's a bullying of the Chinese athletes.
Well, they got tested 7 times a day.
Yeah, well, the statistics show that they were tested, I think, an average of 21 times. And I think the strongest athletes were tested something like 40 times altogether.
Okay.
Yeah.
Well, we understand why the uproar
could be a distraction.
Is there?
Yeah. All right. Min, thank you. Our China correspondent, Min Lo, there. And the latest when it comes to the Paris Games and obviously China, taking the lead so far when it comes to the gold medal count as well. There is also one person that you might not find posting on Chinese social media right now, and it's quite rare to not hear from this person. Bloomberg has learned, you may remember who he is, the former Global Times editor-in-chief Hu Xijin's Weibo account has been suspended after he posted comments on the economy. It seems like we haven't heard from him since Saturday.
Yep, and he posts multiple times a day, if I'm not mistaken.
Yeah.
And it was a post... let me just find that here too. It was a post about how he signaled this historic shift in policy as it pertains to the standing between public and private enterprises.
Yeah.
And he basically, I think, said...
Which he said was a positive thing.
Was equal footing, yes.
Yeah.
Yes. And then, of course, the censors came in. His account has been suspended since then.
Yeah, it's interesting because, obviously we've seen he's been quite prolific, I guess you could talk about. He's an insider among the Communist Party. He's been very good about, posting things, as you mentioned. So the fact that he's now been silenced in some ways as an insider does show basically where those red lines are when it comes to really reporting about these things in China, too.
Yeah, and the timing, too, is because just today, one of our other top stories was Huang Yiping, which is a PBOC advisor, very well-known economist in China, right? The former chief China economist, I believe, at Citi. He was at Barclays. He's now, I think, a vice dean dean at Peking University. And he actually came up with a critique in terms of cyclical economic policy and how he thinks it more effectively should be done.
It's too conservative, he says.
To tackle this low inflation environment. So it's hard to put these two things together, but they're obviously in the same breath as far as the sensitive conversations around the economy are concerned.
And we haven't gotten a comment from him, but I think he did speak to Tsingtao saying, look, just don't ask anymore. It is what it is, sort of thing. Let's take a look at these markets, though, and the state of play here right now. It's not looking too good, especially even when these comes to these Macau casinos. It's a broad sell-off overall, but you add that to some of the gaming revenue numbers that we got for July. Didn't look too pretty either, despite a pretty busy travel season.
Yeah, so you couple the overall, you're right, you couple the overall risk aversion out there, the unwinding of the carry trades, the crowded trades to broaden it out, and some of the earnings that are really coming in bad. So I think Daiwa is a good example of that. So Daiwa came out with earnings, and then you have the sell-off that's taking place over in Japan. Chips, as you can see, also pulling back ever so much. And when you look at U.S. futures, it does seem that this might actually carry over into the U.S. session on Friday. Watch this very closely, and we'll leave you with a look at your global macro movers for you. And if you do need a market visual of what it probably looks like to pull your nose hair, this is exactly it on your screens. Asian stocks are down the most in 2 years this Friday. That's it from us here on The China Show. Have a great weekend, everyone. We'll see you all on Monday. Bloomberg Markets Asia is just ahead.